Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Joining us now is Seth Carpenter of Morgan Stanley. We're so pleased to say, Seth, what stands out to you? Initial jobless claims actually having an upward trend, or this idea that housing is flat on its back?
I mean, I think if I take them all together, I'm actually pretty constructive on the U.S. for this year as a whole. However, I think it's clear to me that we're going to see slower growth over 2024 relative to 2023. And so the incremental softening that you all were talking about when you talked about jobless claims and where they were going, you always came back with some sort of adverb to modify how much it was up, sort of slightly, modestly or whatever. So it's not as though things are falling off of a cliff. I think for the housing sector, it's really important. Supply for single family homes is clearly constrained because anybody who's got a 2.5% or 3.5% mortgage, they're staying put. And so the supply, as Mike was saying, is constrained. On the other hand, monetary policy has always worked through the housing sector primarily, and I think builders have to be a bit cautious because they got to ask themselves, where is demand going to be? And so what does it mean? I think it just means all cumulatively together, we're getting that modest slowing in the economy. We think things should slow down. We think inflation's coming down as well, and taken together that allows the Fed to cut. But I don't, for now, see any of these data as being harbingers of just doom, of somehow that we're going to go off of a cliff anytime soon.
Well, we can find plenty of people who probably do find it doomsaying, and this sort of question of a tipping point has often been thrown out there. Neil Dutt is saying this is the time to cut rates because if you don't, you never see a linear increase in unemployment. You never see a linear kind of weakening in the jobs picture. What gives you comfort that we're not seeing the precipice of some sort of market increase in unemployment at a time where we are seeing an inflection higher in jobless claims?
Well, we've also never seen an economic recovery from a global pandemic like the one we're living through right now. So as we were coming out of the pandemic, there were lots of frictions, lots of dislocations, lots of things trying to sort out where to be. Businesses were running shorthanded for years at a time. And so now we're seeing them settling into, wow, this is staffing closer to what we're going to want in the long run. And so that kind of readjustment from a truly unprecedented shock, I think we're now starting to move into the more normal stage. So to say that we haven't seen this situation before is true. On the other hand, we haven't seen this situation before, and so drawing massive conclusions about whether or not this sort of pattern is telling us something, I think we want to be super cautious.
Not to ask you to draw a massive conclusion, but can you add just the retail data we got from earlier in the week into this, that there does seem to be some price fatigue? So you have companies who are not as worried about labor shortages, and now their margins are starting to get squeezed.
Absolutely. So we think of this as all going in the same direction. If we look even the full quarter for the first quarter where we have all the data for the quarter, durable goods spending quarter on quarter was negative. Non-durable goods, inflation adjusted, was flat quarter on quarter. So where the residual strength was for the consumer was in services. That's exactly the sort of slowdown that we've been expecting to see. And I think the retail sales data, again, overweight goods sort of shows, the consumer's not dead. The consumer hasn't stopped spending entirely. The consumer hasn't said, that's it for me, I'm checking out. Instead, what they said was, yeah, we've already bought lots of lawn furniture. We've already bought lots of computer screens. We've already bought a home office 3 times over. Maybe it's time to cool down a bit.
Two issues you just brought up there. One is consumers, and they're concerned about higher prices, so they're becoming more discerning, but also what's going on in the labor market. Two issues that you say are the biggest when it comes to the U.S. election: tariffs, which many would say inflationary, and also immigration. How are you looking at 2025?
With a lot of trepidation, because lots of different things could happen. I agree with you. When clients ask us questions about the elections, immigration and tariffs are two really important things. I would say to the earlier conversation about have we ever seen a situation where the unemployment rate drifts up gently over time. It's not very common. On the other hand, neither is the kind of increase in the labor force that we're seeing from immigration. That's not very common either. And so in lots of ways, the gentle rise in the unemployment rate that we've seen, 4% unemployment, I'm old enough to remember when 4% was considered pretty good. So we did see a rise on net, but a big chunk of that has been coming, at least over the past year, from increases in supply. And I think immigration matters there. And so with the election, we put out a piece of research for our clients over the past week or so, and you could see a range of outcomes of what happens to the labor force depending on policies that get put in place. And there, I just think the range of outcomes from the election is vast, and we have to be super humble about what's going to happen. You could see big constriction in the labor supply, which would be adverse for growth and could be inflationary. Or you could see things sort of status quo, a little bit of a reduction, in which case the economy gets to trundle on.
We have to be humble, or the Fed has to be humble? How do they think about these kind of potential massive changes while they're deciding whether or not they're going to make a cut before the year end?
So I think humility is called for all around, particularly for anyone in economics where we're not particularly good at it on average. So we need to practice humility a lot. For the Fed, they're going to have to sit back and wait on the policies. I do think if we listen to Jay Powell, if we listen to sort of where our analysis is that monetary policy is currently restrictive, they can come off of the peak now this year and not have to worry about having done too much in terms of easing policy. I think as we get into 2025, though, they probably do need to think a lot more about what the election outcomes mean for policy, fiscal policy, tariff policy, all other policy, immigration policy, before they can have any sort of conviction about which way they need to go with policy.
I asked Terry Wiseman, is this fun? And he just said no. Is this fun for you?
This is, I have to say, one of the most challenging macroeconomic environments to do forecasting in, and it's a double-edged sword because on the one hand, very hard to do forecasting when there are so many cross currents and so many situations that you haven't seen before. On the other hand, maybe it's a good time to be a forecaster because nobody else knows what's going on either.
Well, the reason why I ask this is just simply because when I try to put together even the themes to really hook into, I'm not sure which takes preeminence. I'm not sure if it's a rate cutting cycle. I'm not sure if it's the weakening, or I'm not sure if it's some of the disruptions that are causing inflationary increases. I don't have a sense of where the balance of risks are. Is it that if you cut rates, you have a resurgence in inflation, or is it if you don't cut soon enough, you fall off a cliff into recession? I could make a good argument for any of these, and I believe it. So how do you sort of plan with any kind of long-term forecast when the likes of Mohamed El-Ariary is saying if you don't have that type of long-term forecast, you're going to have a mistake and you're going to have just volatile markets that are going to essentially break?
So I think that's fair. Lots of volatility in the real side of the economy and in markets. I do think the time horizon matters a lot. So some of our clients are very short-term focused, and they're, say, for the rest of this year, I feel pretty constructive. I don't see a scenario where the U.S. really falls off of the cliff over the course of 2024. I do see inflation coming down over the rest of this year pretty substantially, and with that, I do see the Fed cutting. Getting beyond that to the medium-term outlook, I think the uncertainty absolutely goes up. I think the elections are a huge component to which way things go. And I think it is impossible to have high conviction. So the best thing investors can do, the best thing policymakers can do is to think about all of the outcomes contingently and to try to come up with your best set of scenarios. And then you will end up in one of the scenarios over time, but you really have to do a lot of advanced planning. This is one of the reasons why when we talk to our clients, we try to say, we're not going to tell you. We're not going to predict what's going to happen with the election. That's a mug's game. However, if we think across the different plausible scenarios, here are what the key outcomes would be for fiscal, for tariffs, for immigration, and then here's how you should try to think about planning for that.
Just to add to this, because this idea, it's been a criticism of the Fed that they're not being more clear in their outlooks. They keep saying we're waiting for more data, and there are people who've been clamoring who say, no, give us something concrete, give us a clear direction. But what you and Lisa were just describing is one where there is not a clear direction. So how would you rate Fed communication in this environment? Should they be giving us scenario analysis? Should they be giving us more clear forecasts? Or is it right just to say, look, we need more data, we don't know right now?
Yeah, I think especially the way you framed it, when some of the FOMC members sort of asked me questions about how they're doing, I actually think under these circumstances, They're doing a pretty good job. The quip I like to give them is be as clear as you can be, but by all means be no more clear than that. And I think they would be doing themselves a disservice. They'd be doing markets a disservice if they tried to be precise at a time when you can't be precise. And I think that would be false precision. I think it would be false confidence. And so when the world turns out different than expected and they have to change course, which is exactly what they should do, everyone will complain, oh my gosh, you told us you were going to do one thing and now you're doing something else.
So just buy NVIDIA. Seth Carpenter, Morgan Stanley, thank you. Savi Synth of Raymond James joining us now. Savi, what are you expecting to hear from some of these investment meetings, the latest being from Delta at a time where it seems like there's an ongoing divergence between people going cross-Atlantic versus domestic?
Yeah, even in the domestic market, things are really strong. This is good demand. There's a little bit of oversupply, and I think that's the difference between the Atlantic and the domestic markets. Is we're still kind of getting back to 2019 levels in the transatlantic market, whereas capacity in the domestic market has surpassed that. So demand is really strong, but you're right, there is still strong demand in the Atlantic, despite what we looked at last summer as being maybe pent-up demand.
So from a pricing standpoint, do you think that domestically you can get, cheaper airfares the way you're not going to be able to get going transatlantic this summer?
I do believe so, and I think you're seeing that in the data. We've seen pricing being a little bit softer. You saw airlines in the first quarter really pull back their growth a little bit, but as we got into the second quarter and heading into the summer, you're seeing mid to high single-digit growth in the domestic market, and that's kind of creating, especially if you're willing to have flexibility in some of those off-peak days or times, there are some better pricing available out there. But as we're heading into July, we're definitely seeing fares strengthen here.
When you look at the domestic market, who's winning this space? Especially we are seeing cheaper airfares.
Yeah, I think consumer wins. There's a lot of kind of optionality out there. The fares are coming in better. You'll hear a lot of the executives say that we're seeing record revenue, and that's true. I think this is probably the highest revenue this industry has seen. The problem is we also are having record costs. You've seen a lot of labor cost increases. Fuel, while stable, which is great news for the industry, it is still higher than what it was in 2019. So there are airlines that are kind of struggling a bit more. I think those airlines exposed to corporate demand, especially large corporate demand, that is starting to see a nice recovery here. I think they'll stand out better heading into the summer season.
Savi, Lisa's been talking about how we're expecting a record travel season, especially around 4th of July, and the ability of airlines, whether they're ready for it, whether they have enough updated planes and what the airports will look like. Can you just contextualize the chaos that all of us should expect if we're planning to travel this summer?
Always be ready. The thing with summer is you have these thunderstorms that just pop up from nowhere. In kind of winter storms, you can see it coming. You can prepare for it, and that's the issue. Air traffic control centers, especially in the Northeast and a little bit Florida, are still understaffed. And so the risk of disruption is greater when there are events. And summer means there are going to be storms somewhere. And so just kind of be flexible. But I think airlines have done a lot to help address that. You've seen, some airlines just change the way they build their network. Some airlines just taking advantage of what the FAA has allowed them to do and kind of bring down capacity in the Northeast to make sure that there's reliability. So I do expect this to be a better summer than we've seen for a couple of years, but it all depends on the weather. So I would say kind of be prepared and flexible.
You're giving me like a little bit of confidence, so I feel better about this. Savi, how about this? Spirit, United, and JetBlue all delaying their analyst days. What's going on?
They all delayed it for very different reasons. So United, they had that FAA review and they just didn't feel like that was the right time to do it. If you look at Spirit, it sounds like they're trying to come up with a standalone business plan, and there are some initiatives they're trying to roll out, and maybe that's taking longer. Maybe they think that the bondholder discussions might take a little bit longer and want that behind them. But generally, look, there's just a lot of uncertainty, whether you look at supply chain, whether you're looking at the economy. And I think airlines are feeling much more comfortable to do their investor days towards the end of the year, where they'll have better clarity on 2025, even when it comes to what kind of aircraft deliveries that they can expect. It's better to provide that towards the end of the year than doing it closer to the summer.
Savi Synth of Raymond James, thank you so much for being with us. Jonathan Miller of Miller Samuel writing this. When the Fed does cut, I suspect there will be an outsized pickup in sales, even with only a 25 basis point cut. Many would-be buyers have been waiting 2.5 years to see easing rates. Jonathan joins us now. This, to me, Jonathan, is really one of the most interesting questions, and I love having you on, as always. There is this belief that when you cut rates, you can do so in a way that isn't going to reignite animal spirits. How much of a rate cut? You see only 25 basis points of a rate cut as reigniting a lot of interest in the housing market. So how does that factor into pricing and this idea that we can get a soft landing with rate cuts given the backdrop that we have right now?
Well, I think that outsized response to the 25 basis point cut or a modest cut of some sort, you have to think of the last 2.5 years have been this era of pent-up demand that suddenly the sort of legs were cut out from under the housing market, and people that were in the process of thinking about it were stopped in their tracks, and everybody's waiting. And the problem with the waiting part is that when you have if you have a rate cut and this surge of an activity, I think you're going to see prices rise again. The only way for more supply, that's been one of the reasons why we've had such price growth, is inventory has been very lacking. We are seeing inventory come in, but we haven't seen the same amount of demand respond to it because of rates. So when you see rates cut, you're going to see a surge, at least in the short run, you're going to see a surge in demand. And that's going to keep prices elevated, which has sort of broken all the rules of economics, where we're talking about record prices and mortgage rates are more than double where they were.
There was a theory out there that when the Fed cuts rates, that's actually going to cause more volume to come onto the market. So you'll actually see more houses go out there, which will actually cause prices to fall because you'll actually get price discovery in a way that we haven't had for 4 years. Why don't you believe that?
So let's take a market like Miami, and there's been lots of discussion about inventories coming in. Over the last year, inventory has risen about 38%. So you'd think, wow, prices are, going to be challenged. But that inventory result after that increase is still 25% below pre-pandemic. So when you look at the percentage of inventory growth, and we are seeing it, and it is good for consumers in the long run, but it's not enough yet. That there was such an incredible deficit of supply that sort of, 100% or whatever the local market number, a big, sort of headline grabbing increase in inventory is still coming from a record low. And it's not even, I won't say it's not even close, but it's still well below long-term norms. And that's the dilemma. It's sort of, everybody's waiting for rates to become more affordable. But in the meantime, I think we're going to see price growth. And so someone waiting for a lower rate, another 50 basis or even more, they're going to be disappointed, because I think 2 or 3 years from now, prices are going to be higher than they are now, even with more supply coming into the market. For example, in a lot of suburbs that we track, bidding wars, especially in the New York metro area, are 40 to 50% of the closings. So what does that tell you about supply? It tells you that it's extremely low. It's not the same in every market. Some markets have more supply than others, but it is still a challenge in housing right now, is supply. And the Fed, if you look at what happened this spring, this is a very underwhelming spring market.
Right.
I think consumers were expecting this is, rates are going to come down and we're going to see this sonic boom of demand. But rates until the last few weeks have really been sort of stuck at an elevated level. And you're not going to see a lot of, you didn't see the surge that everybody was expecting this spring. And now the consumers are, I don't know if anybody's taking the forecast seriously, because it's like we just keep setting the rate cut date 2 or 3 months from now.
Well, if you are one of these people who had been hoping for that 25 basis point cut to be the thing that ignites things, and not just ignites things, but to Lisa's point, makes housing prices going down, asking for a friend, when does that moment come? How long will it take for enough supply to come online that actually you see some relief?
I think it's 3 or more years. I think it's not a couple of quarters. I think it's a long process, because rates were too low for too long during the pandemic, and literally existing inventory was wiped clean off the earth, basically, and we're coming from a very low point. And that's a challenge. And in fact, in this period, new development or new construction, which is only 10% of supply, is where we could see faster supply coming into the market, but that's only 10% of the market. The other 90% is based on organic growth, and it's starting from, a very low point, and that's the challenge.
Can we talk about the rental market in New York? Manhattan prices are actually decreasing. Why?
Yes, actually, Manhattan. So the way to think of pricing in Manhattan on the rental market is it's almost like it's a choppy. I don't know if you call it a bottom, but it's this. 1 month it's up, 1 month it's down. It's been like this for about 6 or 7 months, but still remaining at very elevated levels. In fact, rents right now are about 20% higher than before the pandemic.
So I guess that when you put all this together, this is actually kind of a counter to what the Fed is saying. They're saying that actually when they cut rates, they're going to be just adjusting things, and that inflation will continue to go down, and that rents are just a lagging indicator, and that they're coming down much faster. From what you're saying, it sounds like that's not the case, and that when they cut rates, they're going to reignite some of the price increases that have kept inflation where it is, given where rents fall in terms of weighting in the inflation metric. Is that true? Is that kind of how you see things?
So that's how I see it, but the sort of the bigger question mark for me is that sort of initial burst in activity of a modest rate cut. How long does that surge or that pent-up demand last? Is this a 6-month phenomenon? Is this a long-term phenomenon? That's the question in my mind. How long will this hold up?
Jonathan Miller, it's always wonderful to see you. Thank you so much for being with us.
Pleasure.
Jonathan Miller of Miller Samuel, at a time when people around this table are inquiring minds about rents and buying homes.
2 out of 3 are.
2 out of 3 are.
Exactly.
Some people have a locked-in mortgage of about 3%, but whatever. Anastasia Amoroso of iCapital saying this: are markets becoming too stretched? The answer is definitely a yes. Near term. And I think it's time for a breather after a monster rally we've had since April 22nd. Anastasia joins us now. So are you bearish, or are you just basically acknowledging that, yeah, things feel pretty heady, and so things could happen?
Look, you have to trade this market. You have to take a week to week. And, if I look at NVIDIA right now, if I look at the NASDAQ, if I look at, for example, the relative strength indicator, it has been screaming overbought for probably the last week or maybe a little bit longer. And when you have this condition, something is inevitably going to happen, and you're going to have some consolidation. You're going to have some pullback. So yes, I do think the trades like NVIDIA and the NASDAQ near term are overstretched, but that's why I really emphasize, Lisa, the word near term, is because I do think there are fundamental catalysts that are propping up this rally, whether it's in semiconductors or something else. And I don't think those fundamentals are going to dissipate. Near term, too much exuberance for sure.
The problem with this idea that fundamentals are good, sure, but how do you price out the kind of gains that we're seeing? How do you price in $1.5 trillion of market cap gains in less than a year for a company with a business model that, yes, seems to be hinged to the future, but that is not necessarily tested in terms of longevity?
Right, but you can see it in the data. You can see it in the numbers. You can see it in the spending intentions, for example, from hyperscalers and also other companies and other governments trying to build out artificial intelligence. I don't think it's a coincidence that the stock has rallied as much as it did when you have, I think in the last quarter, you have a 427 year-over-year increase in data center spending on NVIDIA chips. So that's what I mean by fundamentals. And I don't think that's a one-off, obviously. I don't think it's a couple of quarters, but it might still be into 2025 that we see this surge in spending on artificial intelligence, because let's face it, this is the biggest, mega trend that we have today, and you either going to implement artificial intelligence or you're going to be left behind. And that's why everybody from a hyperscaler to, I think, a smaller fintech company, to probably a logistics producer, all of those companies are figuring out how to embed AI, and you can't do that without those core chips.
Even though some of the fundamentals are there, if I wanted to build a really successful trading strategy this year, what kind of would have been simple? I'd get all of my best quant friends together, which, I have many, not really, and put together an equity momentum strategy. In fact, that strategy's done so well, market neutral momentum, that it's the best year from it for 2007. So it's clear that a lot of algos are riding this wave. I'm worried about the bots. Should I be?
Well, if the trend is your friend, you shouldn't be, right? But the question is, what's going to derail this at the very moment? And actually, this is something that we're thinking about as we ponder the second half of the year. What are the risks? One of the risks is that maybe growth is too weak. The other one is growth is too strong. The third one is maybe NVIDIA or artificial intelligence doesn't deliver near term. So and of course, there's politics. There's the elections in France and the United States. So if any of those things present a hiccup, then I think that's when you worry about the unwind of those trends. But I think the comfort level in the market right now is that those are periphery risks, but and we've been talking about this, we're in the sweet spot right now because, if growth is strong, that's great for all sorts of trades. If growth is weak, well, guess what? The Fed is going to step in and actually cut interest rates. So that's why I think so many investors have been sticking with the trades that are working.
Even so, even if growth is strong, you look at what some of the earnings estimates are for next year. We're at 14%, I think, is the latest consensus, which would make it the strongest year for S&P earnings since 2008 if you get rid of some of the COVID weirdness from 2021.
Yeah.
Does that make sense to you, or do we need to reckon with something different if there is a tinge of slowdown in this economy?
Look, this makes sense to me because one of the things I'm encouraged by beyond the artificial intelligence, momentum is that I actually think there's a fair bit of economic momentum globally. For example, it was all about the U.S. consumer really holding up the overall global economy. We still have the U.S. consumer, but we now also have the global economy that's pacing something like 4% growth versus 0.8% that we saw just a few months ago. We also have the global manufacturing momentum that's really picking up in the United States, in China, and Korea, Taiwan, Europe. So that's a whole lot of, to Lisa's point, broadening out that I actually think is playing out beneath the surface.
Based off the retail sales that surprised the downside earlier this week, are you concerned at all about cracks in the U.S. consumer?
It's the story of that bifurcation, unfortunately, that continues to play out. And for example, when we look at the spending intentions and the perception of prices across the consumer cohorts, unfortunately, the lower income consumer is seeing that price pressure and is therefore lowering the spending intentions. So that's one thing, that you don't actually see the same dynamic in the higher income consumer. The other thing that's happening, of course, when you look at credit card default rates, for example, that's the same dichotomy. We're seeing some of the normalization in the lower income cohort and those delinquencies rising, but that's not the case, for example, when you look at American Express and you look at those default rates. And the last thing I would say, look, retail sales are important, but it's not your entire consumption basket. It's what you spend at some of the online shops and brick and mortar and gas stations. But when you think about what especially the high income cohort is going to be spending on, it's entertainment, it's travel. And you're seeing very strong momentum in those parts of the economy.
I also want to ask you about the politics of Europe because you have a call on this. You think now is the time to actually pile in?
I do. We wrote a piece and we called it the Summer of Europe. And, I don't think it's just a summer trade. I think beyond the politics, I'll come back to this in a second, but beyond the politics, I think there's a lot of strong economic momentum that's playing out in Europe. If you think about Europe in the last couple of years, you had a spike in oil, in natural gas prices. You had a spike in mortgage rates because 53% of those mortgage rates are adjustable rate mortgages. So there's a lot of pain that has occurred for the European consumer. But you fast forward to today, today, and we have one rate cut that's already in place, hopefully more to come. And so I think the peak pain from mortgage rates is now behind us in Europe. And so when I look at the real disposable income and the forecasts that we have for this year and next, they're supposed to pick up relative to where they've been last year. So that's why fundamentally business confidence is recovering in Europe, and I think there's a lot to like from the economics. And then when you look at prior election cycles, for example, 2017, we did see that volatility picks up into the election. It's likely subsides thereafter. So I think there's enough precedent to say that election volatility should be bought.
Do you think that basically U.S. traveler is going to single-handedly support the European economy? I'm just saying.
Well, Lisa, I don't know about you, but as far as everybody I talk to seems to be heading to Europe this summer,
right?
And obviously there's data to support that as well.
Yeah, well, I mean, I'm just wondering how much this is actually going to help. When you put it all together, what you're saying, it seems as though you're not bearish on NVIDIA, but you're not bullish, particularly at this point, in order to sort of see a massive surge. Basically, don't get out, but it might be a little late to get in. And that basically, right now, the gains are to be had elsewhere. Is that basically the way that you would frame it, that independent of all of the uncertainties of rate-cutting cycles and elections, that right now, if you just follow the economics, things aren't that bad. They're not going to get that bad. The broadening out's going to work. And some of the really kind of expensive trades might need to pause for a while.
That's right. I think there's some rebalancing that can be done in the portfolios right now. I don't think you should wholesale get out of the NVIDIA or the NASDAQ trade, but maybe, just maybe, you want to pare back some of those gains that you've had in the positions, and maybe you want to reallocate some of those parts of the market that actually consolidated over the last couple of months and have not participated. And so things that I would be looking to is partially consumer discretionary, consumer finance. I mentioned that some delinquencies are rising, but they're actually pretty well in check and normal. You may want to look at the industrials sector as well, because actually the manufacturing momentum is rising, and manufacturing upswing typically lasts about 9 months. So I'm not saying get it wholesale out of the winners, but peel a little bit back and reallocate to the broadening out trade.
And Anastasia, it also might be time for vacation. Have a great time on your vacation. See you on the other side. Anastasia Amoroso of iCapital.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.